Hello guys, welcome back to my channel Crypto Talks. In the last video we talked about how to buy in Bitcoin. So in today's video I am going to talk about what are the legal risks to the cryptocurrency investors. Along with the explosion of internet in cryptocurrency, there is a growing need for clarity regarding the legal implications of these new currencies and the technologies that drive them. Regulatory agencies, tax authorities, and central banks around the world all are working to understand the nature and meaning. All individual investors can make a great deal of money investing in them, but they also assume certain legal risks when they buy and sell cryptocurrencies. Cryptocurrencies and taxes. One of the most critical legal consideration for a cryptocurrency investor has to do with the way that government tax authorities view cryptocurrency holdings. In fact, their views are evolving, and cryptocurrencies investors need to keep an eye on their latest pronouncements. Capital gains and cryptocurrencies. In the US, the IRS has defined cryptocurrencies as property rather than currencies. This means that individual investors are subject to capital gains tax laws when it comes to reporting cryptocurrency profits and expenses on their annual tax returns. Regardless of where they purchase digital coins, note that the above is true for investors who buy and sell cryptocurrencies. If you are the employee and receive cryptocurrency as salary, it is taxable as income. The amount is based on the value in US dollars of the cryptocurrency and the time it was paid. Cryptocurrencies and foreign bank account regulations. Cryptocurrency trading frequently involves holding cryptocurrency as a foreign account. As of January 2022, federal law does not view a foreign cryptocurrency account as a type of reportable account. This is cryptocurrency account holders are not required to file disclosures of their foreign accounts to the Financial Crimes Enforcement Network, in short FinCEN, an agency of the US Treasury Department, commonly called an FBA. For foreign bank account report, this is FinCEN Form 414, and it must be filled by holders of substantial overseas accounts. Cryptocurrency wallets are not included in that requirement, but that could change at any time. FinCEN intends to propose amending the filling requirements regarding foreign bank accounts to include cryptocurrency holdings. IRS Form 8938, known as FATCA, is the tax agency's version of FinCEN's FBA. Taxpayers with the substantial assets in foreign accounts are required to file the Statement of Special Foreign Financial Assets as well as the FBA. As of January 2022, the IRS has not definitely ruled on the subject. The question of whether cryptocurrencies wallet owners must have report their holdings using Form 8938 is unclear. Blogs for lawyers, accountants, and cryptocurrency investors are awash in the debate over whether a wallet is a financial institution or whether the IRS think it is. A common sense piece of advice comes from a blog run by Blockpit, which specializes in cryptocurrency tax compliance. Give the secret penalties for failing to file an FBA, a FATCA, or a both. Owners of cryptocurrency wallets should file both forms. Infractions are punishable with a $10,000 fine value, and criminal penalties are at the very last. Consult a tax professional who has some familiarity with cryptocurrency when it comes time to file your taxes. Cryptocurrency's decentralized status. One of the great draws of many digital currencies is also a potential risk factor for the individual investor. Cryptocurrencies by definitions are decentralized, meaning that they have no physical presence and are not backed by a central authority. while governments around the world have stepped in to assert their regulatory power in various ways. BTC and other digital currencies like it remain unattached to any jurisdiction or institution. On one hand, this frees investors from being beholden to those institutions. On the other hand, the status could result in legal complications. When there is no central authority, the value of digital currencies is dependent entirely upon the value that other owners and investors ascribe to them. This is true across all currencies, digital or fiat. Without a central authority backing the value of a digital currency, investors may be left in the lurch should complications with transactions or ownership arise. Another potential risk associated with cryptocurrencies as a result of their decentralized status has to do with the particulars of transactions. In most other transaction currencies with a physical presence, change hands. In the case of electronic transactions, a trusted financial institution is involved in creating and settling deposits and debt claims. Neither of these concepts apply to cryptocurrency transactions. Because of this fundamental difference, legal confusion between parties in various types of digital currency transaction is a real possibility. Once again, because of the decentralized state of these currencies, the path of legal recourse in this situation can be difficult to assess. Cryptocurrency registration and licensing. A growing number of businesses are taking a digital currency as a form of payment. In 2022, you can spend your Bitcoin at Microsoft's Xbox Store, Home Depot, and Whole Foods. As in other financial areas, business may eventually be required to register and obtain license for particular jurisdictions and activities. However, due to digital currencies' complex and evolving legal status, this area is significantly less clear for business operating in the cryptocurrency market. Companies that only accept cryptocurrencies, for example, may not need to register or obtain licenses at all. On the other hand, they may be required to submit to special consideration depending upon their jurisdiction. For example, at the federal level, financial institutions must maintain certain protection activities against money laundering and fraud. The transmission of funds and more consideration also apply to business dealing with digital currencies. Fraud and money laundering. There is a widespread belief that cryptocurrencies provide criminal organizations with new means of committing fraud, money laundering, and a host of other financial crimes. This may not directly impact most cryptocurrencies investors.